How much house can you actually afford compared to what Zillow says? For example, if Zillow says you're approved for a $550,000 house, there's a 50-50 shot that probably won't work. And let's talk about it. Let's see why and what makes a difference. I've talked about this in other videos and other content, that one of the main things that lenders look at when approving for a mortgage is what we call a debt to income ratio, or DTI. What DTI is, they take your gross monthly income, they take half of it, so roughly about 50%, and all of your bills, all of the items that are listed on your credit report and your new mortgage have to fit within that 50%. There's a couple outside items that won't report that are required, but for the majority, let's just concentrate on these items. So let me give you an example. Let's say you have a car payment for $500, you have a credit card payment for $100, student loan for another $100. Those items in total, before you add your mortgage, is $700. Now let's get back to this $550,000 house. Let's say you bought a $550,000 house and you put down 5%. Your loan amount is $522,500. At a 30-year loan, at a 5.99% interest, your payment, not including taxes and insurance, is $31.29. Let's add in another $600 a month for taxes and another $200 a month for insurance. Now, just your house payment, including taxes and insurance, comes out to $39.29 for that same $550,000 house. Now add in $700 in outside bills. That puts you at just under $4,700 a month in just your fixed expenses. Okay. Now, on paper, let's say you made $10,000 a month. 50% of that is $5,000. That $4,700 fits in that number. Great. In your head, you're like, oh, that's fantastic. Let me go ahead and buy this house. Slow down. Here's the reason that people need to take other things into consideration. Lenders use your gross income to qualify you versus you pay all of your bills in your net income, which means your taxes are taken out. So let's say that same $10,000 a month income after taxes, let's call it $7,000, maybe $7,200. So now you're paying all of your bills, so $7,200 minus $4,650. Okay, just using round numbers here. That leaves you with $2,250 a month for living. You still haven't eaten, you haven't filled your car with gas, you haven't gone out to eat, you haven't gone to a party, you haven't bought any clothes, you haven't done maintenance, you haven't put money into savings. Is $2,500 remaining a month enough for you to live and live comfortably? For most people, I can tell you right now, it's not. You're not going to be able to save money. You're not going to be able to eat what you want and go out to eat and live a comfortable lifestyle if you're stuck to $2,500 a month. It's just the reality. The world is expensive to live in. So a couple things you need to take into consideration that people don't talk about. You need to take into consideration your food costs every month. Take into consideration how much you spend on gas. Take into consideration how much you spend on Amazon, your streaming subscriptions, how much money you spend on coffee. And I know these things may sound silly and minuscule, but the reality is they add up. When you add in daily coffee at Starbucks, is even on the low end $5 every single day is a couple $100 a month, and you only have $2,500 to spare. So all of these things need to be taken into consideration. You need to look at the budget as a whole, and you say, hey, what am I going to do, or how am I going to live based upon this new loan? I see time and time again, people are purchasing homes at the maximum approval amount. They get approved for $550, at 49.9%, and they sure as hell buy for that much, and they really don't take into consideration their other living expenses. Right? And then I sometimes advise this to clients all the time. And I say, hey, if you're in like a dual income household, try and be qualified on one person's income. Because then no matter what happens, when you have dual income, you're going to still be able to live a comfortable lifestyle versus all your eggs in one basket, right? There's nothing worse than being house poor. You got a beautiful house, but you got no furniture. You can't go out see your friends. You can't bring people over because you just don't have the means. You're stuck living a lifestyle that you probably didn't plan for just so you could have the house. So take these into consideration. When lenders factor in your debt to income ratio, they take in a couple, main items. So all of the debt on your credit report that we talked about, your student loans, car payments, credit cards, installment debt, so on and so forth. They also take into consideration property taxes. They can take into consideration home insurance, homeowners association dues, HOA dues. If you pay child support, there's a lot of different things that can come up in your process that you may not consider when it comes to your approval, right? They don't take into consideration your electric bill. What if your electric bill is $200 a month? Your gas bill is $200 a month. Whatever it may be, all of these things are additional costs. Let's say you bought a house with a pool. Well, now you have the maintenance for the pool. You have the additional cost for having a pool. What if your house needs a new roof and you got to pay for that? You want to make sure you're setting yourself up to be comfortable, when these emergency arise, because now you're the homeowner. Nobody's paying to fix your floors. Nobody's paying to fix your roof or windows. That's on you. Also, the credit card payments that they're taking into consideration are the minimum payment. Well, most people, I shouldn't say most, but a lot of people pay the minimums, and sure, that'll help them get by. But if you're paying off your credit card every month, or you're paying, large amounts balance on your credit card, take that into consideration. So now what about childcare? Now you're in a situation to where, the lender doesn't take into consideration. Let's say it's $1,000 a month, which is not a crazy amount from what I'm hearing. So $1,000 a month of childcare. The lender doesn't know that. They don't take it into consideration. That being said, you as the new homeowner have to. So let's backtrack. Let's say we're going to go back to that $550,000 purchase, right? Let's see if this makes sense. At $550,000 with a 5% down payment, to reiterate, your loan amount is $522,500 on a 30-year term. Let's say the interest rate's 5.99. Your payment, not including taxes and insurance, is $3,129. Add in $600 for taxes, add in $200 for insurance, and those things may vary depending on your city, county, or your insurance policy. But just for your house, you're at $39.29. Now, take into consideration your car, $500 a month. Your credit cards, the minimum payments are $100 a month. You have student loan debt. Let's say you pay $100 there. Now you're at $46.29 a month. Your qualification amount is only based upon $10,000. Again, in this example. So at $10,000, half of that for your debt to income ratio is $5,000. So you guys tell me, if your bills, your fixed bills, and you still haven't eaten yet, you still haven't paid for childcare, still haven't done any of these things, are at $4,600 a month, and your qualification is $5,000. Should you be buying this house? Maybe tapping yourself out. Maybe too tight. You're going to take away the comfortability of your lifestyle, because if your gross or your net income is $7,200, that leaves you with $2,500 for the month. Now let's talk about childcare plus $1,000. You still haven't eaten yet. You're probably going to eat for at least $800 a month. Now you have $600, $700 for the month, and that's still bare minimum. Long story short, you have to look at the big picture. You got to know your numbers before you make such a commitment. And if you need any help, give me a call. We can go over them together. We can put together a plan. We can look over your budget and just see what makes sense. Talk to you soon, guys.